we run our entire infrastructure, not just like on one cloud-based provider, but we have multiple redundancies. We are actually constantly running 3 real-time copies of our records at all times, second to second, 24 hours a day, 7 days a week. So we're really keeping 3 completely separate operating environments in sync and running them constantly. So it's a big technical challenge when you're really trying to do this at an enterprise scale.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name's Simon Taylor. I am your host for today, author at FinTech Brain Food and head of market dev over at Tempo. And joining me once again, back from a good holiday break, is the one and only Kai Sheffield. How are you doing, my friend? Are you feeling refreshed and ready to go?
It's great to be back. It was a great break, but I am excited for 2026. It is going to be a fun and fascinating year. We've got amazing guests to kick off the year, so let's get into it.
You're exactly right, Kai. And to kick off 2026, we are joined by an incredible guest, Sandy Kaul, who is EVP and Head of Innovation at Franklin Templeton. Welcome to the show. Thank you so much for being here.
Thank you guys so much for having me. Excited to be here today and kick off the year with you.
Let's kick it off right. And just as we always do, I need to remind everybody that views and opinions of contributors today are their own and might not reflect those of the companies they represent. And please always do your own research. Don't take anything we say as tax, legal, or financial advice. We'll get into this right here. All right, the first story, Kai, I don't know if you saw this one. I couldn't escape it. The fintech company OnePay, who is backed by Walmart, have gone live with crypto. So you don't pay for your groceries with Bitcoin with this. It's a neobank-like app with about 5 million users. You can buy crypto in the app, you can sell it, and those proceeds, when you sell them, hit your OnePay cash balance, which you then can spend as dollars at the register. The point of sale never sees crypto, it sees USD. So this is really quite interesting move here, both with my fintech hat on and with my sort of institutional adoption of crypto hat on. But Kai, was there anything that you want to give that you saw from this contextually that you thought was interesting when you saw the story?
Not at all surprising. I think this is a trend that we're seeing of more neobanks that are looking to become financial super apps, and crypto trading, buy, sell, and hold is kind of one of those features and capabilities that fits as part of the broader strategy. I think one of the biggest takeaways I see is, you can have an announcement like this lead to a headline of, Walmart enabling crypto payments. And then you peel it back. You're like, wait a minute. Okay, so OnePay, which is existing super app that Walmart is kind of associated with, is doing buy, sell, and hold, but there's no notion of actually paying directly because that doesn't really solve a real problem for them. And so, as much as people are excited about Bitcoin and have talked about the Lightning Network, if you would have told them, oh, Walmart's interacting with Bitcoin and Lightning, there were people who thought that would be from a payment standpoint. But it seems more and more that what the market is telling us is that Bitcoin is an asset that apps are integrating to buy, sell, and hold, and they're not necessarily looking, to enable it to be spent. I would say Cash App and Block is the exception. They're going full steam ahead trying to enable Bitcoin to be spent at the point of sale. I think they're one of the only data points that we've seen of a very legitimate payment company that's really, really pushing for that. Everyone else is focusing on the buy, sell, and hold. So that was my biggest takeaway.
Yeah, and Cash App as well have announced support for stablecoins, and they're going to launch their own as well. So even they're showing some flexibility. Sandy, your thoughts with headlines like this and kind of bigger institutions adopting Bitcoin and crypto? I know it's something that Franklin Templeton has been really a bit of a pioneer in.
Yeah, I think that, these are really illustrative of how people's financial life is becoming all one. Right? It used to be I would have a banking account, I would have a separate investing account, I might have a separate retirement account, I might do some betting on the side on things that I was interested in. And these were all different lanes in my life. And they are all coming together. This idea of the super app is really unfolding in front of us. But I do think that, this is a healthy way of thinking about the world, right? If we're going to transition to a wallet-based ecosystem and away from all of the different accounts that we operate on today, right? This is a necessary step, right? I am going to aggregate more and more of my financial life in my wallet. The app that allows me to access and optimally use those assets in the wallet is going to become where I want to live my life. It's almost like Amazon with shopping, right? The easier it is to shop for everything on Amazon, the more I'm on Amazon. And so I do think this is the direction of travel for the world. I think that a lot of traditional wealth managers have not yet woken up to the threat that this poses to their traditional business. But I do think that a lot of the banks, at least, are starting to wake up to the threat that stablecoins provide to their business. So I think that this will probably be the year that we see the great wealth management awakening to the threats that this provides.
Interesting that the distribution side, as you say, the app side is rebundling all of these different products. You could talk about Robinhood, you could talk about Coinbase, you could talk about many others that have started to go that route, and now OnePay. In your own business, what are you having to do to prepare for that future in the wealth management sector? Like, how do you get ready for wallets and tokens and all that sort of stuff?
Well, this was something we saw coming many years ago, right? I mean, we actually designed our own KYC, AML, which is Know Your Customer, anti-money laundering. We designed our own KYC, AML compliant wallet working with the SEC. We've gotten a patent on that wallet. And we built an entire tokenization platform that can issue tokens, trade tokens, registered fund tokens. And we actually launched our first tokenized fund on that platform all the way back in April of 2021. So we've been operating in this world for quite a while. We now have funds that trade all over the world that we administer via this wallet-based ecosystem. And we're going to be launching many more products into this wallet-based domain over the coming year to 18 months as the market is finally catching up with the benefits that these wallets provide. So Franklin Templeton has been ahead in this regard. What we're finding now is we're needing to do a lot of education. We're having to do a lot of explaining. We're needing to really help people understand why these technologies offer a much better opportunity, right? In financial services, we've had wrappers for decades, right? Mutual fund wrappers, ETF wrappers, separately managed account wrappers, right? And those wrappers have all each offered some incremental improvement to how you can trade financial instruments. But tokenization is a step change beyond that, right? Because they are programmable, for the first time, we really have smart wrappers. And putting a smart wrapper into a digital wallet on a blockchain enables things that have never been possible in the past. And I think that's what we're starting to see many traditional financial participants realize. And they're realizing that, oh my, I need to actually rethink my whole business as a result of this.
So it seems like you all are leading the way on tokenized securities, tokenized money market funds, and like the wallet infrastructure that you need for those types of products. Do you think about it as that same infrastructure will be general purpose to support any asset, including crypto assets, including stablecoins, and that it'll all live together in the same place? And maybe I'm behind on the headlines, but like today you offer tokenized money market funds. Like, should we expect that it's any asset on chain could then live right next to them in the same wallet? Is that the general direction that you're going?
100%, Kai. That's exactly the vision we have for the future. First off, we are an asset manager. Franklin Templeton has been around for 80 years, and we manage almost 1.7 trillion in assets under management. I would see all the different types of products we provide across that $1.7 trillion platform eventually moving into these channels and being available in a wallet, just like we have it available in a fund today. But in addition, that's just stage one, right? There are so many assets today that are investable, but they are very difficult to trade, right? You think about intellectual property rights, you think about art, you think about farmland, you think about sports teams, you think about movies, right? There's any number of assets that people would love to be able to invest in, but it's hard to invest as a small investor. It's hard to get small shares of those investments and be able to create liquidity around them. And I think all those types of investments too are going to be moving into tokenized wrappers. They will become part of investment portfolios, and those investments will sit side by side with your stablecoins, with your Bitcoin, with your other tokens in your wallet. And that becomes my modern portfolio, right? My portfolio today is typically just equities and bonds. I think my modern portfolio has dozens of different kinds of assets in it.
Historically, the 60/40 portfolio was the good advice you start your career on, and that's what you're supposed to do. But for this generation, that's not necessarily returning something when asset prices are so high. And so no surprise that some of them have turned to meme coins and whatever alternative they have available, a trend some people call financial nihilism. What I find fascinating about what you're saying is there's also other alternative assets that do have better yield profiles. Those alternative asset classes like IP, like art, like wine, like many others, that professional investors have been using for some time to give a higher return profile and as part of a balanced portfolio. Why don't we wrap those? But the reason we didn't wrap them is they were very expensive. It's very costly. Taking a fund meant that the hurdle rate, you have to invest, $1 million to $5 million to walk through the door, and most consumers don't have that. But tokens easily fractionize, and they're wallet first, and they enable you to do all of that. So it's fascinating that you've already got started, you're already live, you're already in production, and you're already thinking kind of that way down. This next story, I would love your thoughts on as well. I don't know if you saw it, that Fireblocks have acquired a company called Trez Finance for $130 million. Now, these guys are an enterprise platform for financial data reporting around digital assets, and they build a lot of compliance capabilities for digital asset corporations by turning blockchain activity into structured audit-ready data. And I imagine this is a challenge you might have had to solve yourselves internally. But this is, kind of a further consolidation in the space. It's the second acquisition after acquiring Dynamic late last year. And we had both Fireblocks and Dynamic on the show back then. Talk to me about sort of some of the work you've had to do internally to be, a regulated financial institution and deal with all of your obligations and still be in the on-chain world.
Yeah, this has been, an ever-expanding learning experience is what we find, that you solve one set of problems and you open up an entirely new set of realizations and challenges. But let me rewind to some of our earlier days in building out our infrastructure, because this data issue is a very important one, right? We realized very early on that if we were going to be utilizing the blockchain rails as a ledger, particularly for holding records of regulated fund shares, that we needed to be able to really access all the data of all the blockchains that we utilized at every moment in time to ensure that we actually had an accurate record of what those shareholders' positions looked like. And so we began actually running our own node operations. And we really do believe that running your own node on these networks is an important operational due diligence procedure that allows you to really be a part of the network and really be engaging with the network moment to moment. And being able to get at that data and have real-time copies of that data second to second is critical for how we have to run the business. So I do think that being able to ingest that data, we had to do a lot of that structuring of the data, that importing and cleansing of the data, that integration of the data into our other systems ourselves. And it sounds like what Fireblocks is doing is trying to create a quicker route to market for others that are going to be buying into those services. And then the other thing we realized is that once you're collecting all of that data and you're relying on that data, you then need to start making sure that you have lots of redundancy in that data. And so, we run our entire infrastructure, not just like on one cloud-based provider, but we have multiple redundancies. We are actually constantly running 3 real-time copies of our records at all times, second to second, 24 hours a day, 7 days a week. So we're really keeping 3 completely separate operating environments in sync and running them constantly. So it's a big technical challenge when you're really trying to do this at an enterprise scale.
That alone, we need to clip that. And that is a playbook for financial institutions that a lot of people don't realize at this stage. If you're serious about building on-chain products, what Sandy just talked through is exactly the mindset that you need to have. And I think it's part of the shift of we've seen, blockchain, stablecoin, tokenization initiatives be kind of in the corner of an innovation center. And when it's there, it's easy to outsource and say, okay, we're going to onboard one provider and just do this through the cloud. And we'll just trust them. There's going to be no backup, no redundancy. I think where we're heading in 2026 is the real value. It's going to be who are the financial institutions who can actually get closer to the metal and say, how do we build and design a stack that is not just going to get us to an innovation POC, but is going to get us to trillions of dollars of assets on chain. And if you're issuing and monitoring trillions of dollars of assets on chain, the idea of outsourcing a critical component, of the data operations of what's happening with those things to one company, a fraction the size of you, is very, very hard to do. So I have a ton of respect for that mindset. And we think about that a lot as how do you get closer to the metal and build a foundation that, can scale over the long term. And I think that that's, the expectation that, large customers of large financial institutions have. But back to the story on Fireblocks, I think this is a really smart move. And it also speaks to the shift of, again, you've had products like Fireblocks that at times have been sold to product and innovation teams, where you're either talking to a developer or you're talking to product manager. It seems like this is a shift towards saying, maybe the customer is actually the CFO. Maybe it's the controller. Maybe it's the auditor. And so, again, as you get to these bigger deployments, if you can be able to have a stack that's not just here's how we're going to manage your keys, but here's how it connects to your ERP, here's how you have an auditing trail, here's how you have all of those other components, I think that's going to be really important for large enterprises. And the CFOs are going to have a real impact on the buying decisions. And so being able to integrate that into things like key management, really smart move by Fireblocks.
I completely agree. It feels like one, logical product extension into net new revenue, but 2, I almost saw it as a signal of this is one of those little things that you would only expect to see if they are getting scale and velocity and volume coming through their platform. People will be asking for that if they're pushing into production. They don't ask for that if they're not pushing into production, right? If it is just staying in the innovation theater division. And I think stablecoins have been a big driver of that. But as Sandy was sharing, I think it's going to go beyond that really, really quite quickly. And I just wanted to echo your point, Kai, before we move on, which is I've had 4 conversations with 4 different banks in the last 2 days, and so many of them start at we just need to figure out how to be an off-ramp, and can you teach us how to do that? And then they get into, oh, right, that sounds like a lot of third parties. I'd need to be able to move quickly. Can I go directly down to the metal? And then you coach them through how to do that. And then there's sort of a different roadmap for everybody of how they get to that. But it's kind of the thing I think a lot of the institutions are going to want to do is they're going to want to figure out how they do what Sandy's already done. So Sandy, you could probably build a little cottage industry and kind of going around the banks and financial institutions and talking to all of the hard-won lessons she had there for sure. Just before we move to our next story, I'm going to take a quick pause here while we hear from our sponsors. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is sponsored by Stripe. Here's a problem so many businesses are up against. Money still moves like it's the 1970s on financial infrastructure that was designed before the internet was even a concept. It's slow, it's expensive, and it's tied to borders. That's all changing now. Stablecoins are fundamentally a better way to move money online. They're affordable with payments that take minutes rather than days. They work across borders, and they're easy for anyone to use, no matter where they are in the world. Stripe allows you to unlock those benefits for your business. One integration, and you can accept stablecoin payments, pay out globally, and manage your money with stablecoins. No blockchain expertise required. Learn more about how you can use stablecoins and expand your reach at stripe.com/crypto. Fireblocks is the stablecoin infrastructure of choice for global businesses, from Visa to WorldPay to Bridge to Revolut. With over $100 billion in monthly stablecoin volume, Fireblocks powers stablecoin strategies at scale with infrastructure that enables PSPs, fintechs, remitters, and banks to issue, move, hold, and manage stablecoins. It's all done securely at scale with secure built-in compliance. With Fireblocks, you get complete control to build your own stablecoin orchestration layer, create payment accounts, manage liquidity, and access on and off ramps in over 60 currencies. It makes it easier for you to build and scale and expand your business globally. Learn more at fireblocks.com. All right, thank you so much to our sponsors. The next story, again, I saw came from a lot of places, but Barclays, my alma mater, has invested in stablecoin settlement firm Ubyx. Of course, we've had Tony McLaughlin, the founder of Ubyx, on this show a couple of times. This is the bank is Barclays' first stablecoin specific infrastructure and investment. And of course, if you're not familiar with Ubyx, they are a settlement business focused on specifically clearing many stablecoins across many blockchain networks with many off-ramps. So classic clearing bank. And no surprise, Tony ran clearing at Citi as his last job. So he knows a little bit about clearing. So any chain, any token, one single settlement layer. So I found this one fascinating, Kai. We've had Tony on the show before. The stablecoin conversation past 12 months has been very US focused, but quietly the European banks have also been doing a lot. We're not seeing a lot out of the UK banks necessarily, but a couple of big stories this week coming out of the UK. What are your thoughts on sort of these investments? Do they signal more? And what are you hearing in your network from banks looking to solve this many-to-many problem?
Yeah, so my understanding is that Barclays has tended to be one of the more conservative banks in the space. You don't see them kind of rushing into a lot of different crypto and blockchain type of initiatives. And so I think it's a good signal to say that even the largest, most conservative banks are recognizing the value of stablecoins and are taking meaningful steps. And the investment in Ubyx, I think, is a start to that. I think it's a lot of shout out to Tony and the network and credibility that Tony has built over the years. And if you can kind of trace the past of he wrote the paper at Citi on regulated liability network that then led to working groups in RLN that then led to the BIS, and so he's been able to build this really impressive ecosystem of leaders inside banks that are really looking at ambitious upgrades to the payments and financial system, and so have been excited to see him with Ubyx now, and being able to have some of the banks that he worked closely with on RLN and these working groups kind of following and engaging and investing. I think that makes a lot of sense, and everyone should go back and listen to the episode that we did with Tony. I think his analogy around stablecoins as traveler's checks is one of the most interesting ways to think about the space, and it's something that if you're a bank, what I've been saying lately is it's really hard to predict every use case that a customer might want to do with a stablecoin or tokenized asset. It's just really hard to know. But it's likely that some of your customers will end up with some of these assets somehow. Like they'll just like come across them, as they're more out in the wild. And so I think a starting point is if you assume that some of your customers have some of these stablecoins, shouldn't you want them to bring those stablecoins to you and just deposit those into the bank to grow your deposits? And then you need the mechanism to do the clearing and settlement to receive the stablecoin, redeem it, for fiat, and then have fiat show up at the bank. And so I think it's just like a very natural starting point. Like you don't have to predict the future. You just have to say some percentage of my customers are going to have these. If they have them, let them bring them to me. And I think Ubyx has like a really strong positioning on how to do that. So shout out to Tony.
Yeah, I want to echo that because, again, to the point I was just making, how many banks are now trying to figure out how they become an off-ramp? And Tony's like, yeah, and then when you become an off-ramp, which stablecoin are you accepting on which network and or which third parties are you working with? Actually, I'll just hide all of that for you and I'll clear it for you. And then, you can take it from there. Sandy, I'm interested from your perspective in sort of the support you're seeing from the banking sector more broadly. I know, and stablecoin settlement, and where you see the opportunity for that versus other assets in your business and what you've been doing in that space.
Yeah. So first of all, I just want to echo your guys' shout outs to Tony. He was actually the person who taught me about stablecoins. He and I worked together at Citi, where I was doing a lot of thought leadership around tokenization as he was doing his work around the regulated liability network. So to me, Tony is one of the absolute greatest thinkers in the space. And I have watched with great enthusiasm as he's built out Ubyx. I do think that, the whole conversation with banks and stablecoins is pretty fraught, right? If stablecoins are really doing what stablecoins are meant to be doing, then the banks are going to be losing those deposits, right? And you see a lot of banks already taking very defensive postures in trying to offer tokenized deposits as opposed to really getting behind and offering stablecoins. Because a stablecoin, once it sits in my wallet, can recirculate wherever I would like to recirculate it, right? Whereas a tokenized deposit has to come back to the bank, right? And I think that banks are hoping that by offering these tokenized deposits, they can create an instrument that siphons off some of these cross-border flows from stablecoins and kind of reduces the outflows of deposits that they're seeing. But to the point Kai made, inevitably you're getting stablecoins both into and you're getting funds out of the bank into stablecoins. So being able to be interoperable across the entire set of stablecoins that are emerging is critical. And I think that stablecoins are going to come from more sources where people aren't going to have a choice, right? A headline that was recently out for us is that we have helped the state of Wyoming launch their own first stablecoin. And we are doing the reserve management for the state of Wyoming. And what's interesting about that is that the state of Wyoming is going to be making statewide payments in their own stablecoin, right? So if I am a resident in the state of Wyoming and I'm getting paid food benefits, I'm getting paid a tax refund, I'm getting paid any kind of federal statewide service, I'm going to receive these Wyoming stablecoins. And I think that this is going to set a model that a lot of other organizations are going to want to follow. So I do think that we are just at the beginnings of this proliferation of stablecoins and different stablecoin types for different use cases. And the banks are going to inevitably have to be able to interoperate across this whole space, or they risk really losing those deposits permanently because once it's sitting in my wallet, and I have any kind of self-custody arrangement, I can start moving those stablecoins around at will. So I do think that, a lot of banks are still trying to wrap their heads around what their strategy should be here. I think they have both a nearer term strategy to kind of prolong any defensiveness that they need to think about. And then they probably also have longer term strategies where they need to rethink where some of their own differentiation comes from. So I think it's a tough situation for banks, but I do think being able to interoperate is going to be critical for all players, banks included.
Yeah, and that interoperability is really key because there's a number of initiatives. There's Swift, there's Project Agora, there's the Clearinghouse, there's Kivalis in Europe. There's countless consortia popping up, and then there's also the internal tokenized deposits. There's Kinexis and there's City Token Services and it's not clear to me that all of these deposits use the same token standard. It's not clear to me that these things could technically interoperate. That if I sent that to a market maker, it would exchange evenly, and on what network would it happen? None of this is really figured out yet. And so having somebody going, I know it's a mess, I'll just clear it, whatever it is like a real it's not a vitamin, that's a painkiller. Like that solves a problem that I think we're inevitably heading towards. Kai, I'd sort of asked you the question about client demand because I suspect that's the case that you're hearing as well. A lot of it's coming from some crypto natives, but also just corporations that operate in long tail markets for cross-border have stablecoins, and they just want to get in and out of their regular bank account. Like they don't want it to be in a different place. Do you think that banks, as people that ultimately do listen to their biggest clients, are going to acquiesce, and we're going to start to see them off-ramping stablecoins in some of the GSIBs? Do you know of any already doing that at a big scale for their corporates?
I'm not aware of anyone that is doing that today at any scale of any like large bank. I think before the holidays, we announced our partnerships with Cross River and Lead Bank and how we're working with them on stablecoin settlement. And so arguably that's one of the first examples of banks that are actually sending and receiving, holding, touching like stablecoins, not just tokenized deposits. So I think that's a pretty big deal, and it makes sense that those are the early movers, and they serve the most sophisticated fintechs and crypto native companies, and so their clients were clearly asking them to say, hey, like we want to be able to send you stablecoins, and so they're building the capabilities. And Cross River, Luca talks about how they were able to integrate that with their core ledger that they built in house, and so you can send a stablecoin and get fiat back, and I think that makes a ton of sense. I think the big question will be from the larger banks, who ends up being the early movers there. And again, as Sandy mentioned, a lot of them are very focused on tokenized deposits and making significant moves on kind of their own products. We have not really seen many lean in publicly today and say, we want to accept all your stablecoins. And I think that there's an opportunity that the first major banks that say we're open for business, send us a stablecoin, and we'll accept it, and your account will immediately show up as a deposit. I think that's an attractive service for a growing demographic of consumers and businesses that are coming across these. But there's a bunch of questions around. I think the infrastructure to do that doesn't exist at scale yet, and so I love what Tony's building with Ubyx, but it's still early stage, and so like how do you actually manage acceptance of a stablecoin across multiple blockchains and the ability to clear it and send it back to the issuer and redeem it for fiat? And are you going to immediately credit the customer's account even before you've been able to redeem the stablecoin? What happens if you can't redeem the stablecoin? Like there are all these things that you have to think through. But I think in 2026, like for sure, like the fintech banks are really ramping up. And then I think you'll see large banks start to dip their toes in. But there is this interesting strategic decision around, you could either say, we're going to go all in tokenized deposits and try and convince the world tokenized deposits are better than stablecoins and you don't need them. Or you could say, like, we're not even going to try tokenized deposit. We're just going to like say stablecoins are going to happen. We're going to try to meet stablecoins where they are. Or we're going to meet somewhere in the middle, like have our own tokenized deposit and accept stablecoins and like figure out how they interoperate with each other. Like I tend to think like that middle lane is probably a better risk adjusted bet than going to the extreme, one or the other. But I think that'll be interesting to see.
You can almost see, I think, the Overton window shifting in financial institutions in Jamie Dimon's speeches on the topic. So if you wind the clock back 12, 18 months ago, and certainly 6 months ago, it was, we believe, deposit tokens, JPMD is superior because it offers yield. Like, why wouldn't you want this? We think it'll outcompete stablecoins, especially when the Genius Act first passed. That has mellowed somewhat. since then. And I think the reality of stablecoin adoption and also bankers, for better or worse, they do this to their clients, especially their biggest clients. When there's demand, they will service it and they will do what their clients need them to do. That's the nature of especially the big banks. So I think it's going to be fascinating to watch. I want to move us to the next story because it's bank related as well. And this is from Lloyds Bank, the other large UK high street bank. They completed the first UK gilt purchase, so our equivalent of treasuries, using tokenized deposits. This was done with the help of Archax, a UK company, and of course Canton, friends of the show. Lloyds issued its tokenized deposits onto the Canton network, and their corporate markets division used those tokenized deposits to buy a gilt from Archax, who was the broker of those gilts. And then Archax moved the underlying fund back to its regular Lloyds account. Sandy, what do you think of this use case in particular? Because I know that's sort of almost reaching into the other side of Franklin Templeton, like it's classic business. Any thoughts as you saw this story pop up?
Yeah, this is just the very tip of the iceberg. I really believe that you're going to see more and more and more transactions being done completely on chain for underlying assets, not just funds. And I think that the forms of payment that people are going to be using is going to be expanding pretty dramatically. We actually, in our thought leadership, kind of refer to it as we're moving into a high-tech barter society. Because not only can I use a tokenized deposit, I can use a stablecoin, but why wouldn't I be able to use tokenized gold? Why wouldn't I be able to use a cryptocurrency, right? If I'm looking to buy an asset, I should be able to buy it with any form of payment that is transparently valued and exchangeable, and be able to do that instantly on chain. And so I think this is really, a strong signal that we are going to see the entire financial market infrastructure shift onto new rails a lot faster than people anticipate, right? The benefits that are gained through this are going to be seen instantly, right? We already at Franklin Templeton can allow clients to subscribe and redeem from our money market funds using stablecoins. We're going to be able to allow them to do that using tokenized deposits. We're going to be able to allow them over time to do that using potentially other forms of payment. And I think that this ability to go seamlessly between these different instruments is going to be, I think, foundational to how the new ecosystem works. And to go back to the conversation we were just having, the banks are going to struggle here because their systems have not been built to operate in real time 24/7 like this. They need to reconcile back using batch processes. And so if I accept a stablecoin as payment, I can give you that stablecoin instantly if you are on chain. But then to get the funds that stablecoin represents back into your bank account, even if the transaction happens on chain right away, the actual funds may not hit your bank account for some time. And I think that this is going to start to be seen increasingly as an unacceptable drag on your own potential money and the way that what you can earn on it. And that is going to push people to transform a lot faster, I think, than many anticipate at this time.
Sandy, I have a question for you that I've been thinking about over break. I'm hoping you can help me answer. I'm going to take like a long-winded way to get there, so bear with me. But I think what you're saying, it really resonates, is the amount of working capital that an end customer needs to have over time should decrease down to near zero. Like if you think about like what does an average customer have in their checking account? Like how much money do they need to have? It's partially a function of how slow it is to be able to take any other type of asset that's not cash and get it into cash. Because my preference would be to keep 100% of my assets and kind of liquid net worth in assets that earn some return, not in cash or deposits in a checking account that are earning barely nothing. But I have to keep some deposits there because of the fact that I have bills that come in and I can't immediately convert an equity that I have to pay a bill that's outgoing. So it makes sense to me that working capital comes down over time as every asset becomes more liquid. Now, what you said around, okay, you could have all these different types of assets that are tokenized, and then you could actually spend, maybe you're spending a fractional share, you're spending a tokenized money market. That seems kind of like a tax nightmare of like actually spending the assets themselves. But the thing that makes a ton of sense to me is, why can't I just get a credit line against my entire portfolio that's cross collateralized against all my assets? So if all my assets are on chain and I have money market funds, equities, crypto, like whatever it is, shouldn't at any point of time I could just open a credit line and be able to borrow, against those assets and then be able to spend? And that would be a really, really powerful product. What are the barriers to that happening? And frankly, why doesn't that exist today? Like, why can't I go in my Robinhood account and say I would like to get a credit line of 10% of my assets in Robinhood that I could immediately spend against? Does tokenization solve that? I don't even understand why it's not happening today with traditional equities outside of these like prime broker, high net worth, like one time type of loans.
Yeah, I mean, in a sense, it's like if we can offer buy now, pay later at a point of transaction checkout, why can't I be looking at my entire wallet-based set of holdings as a collateral base that I could be borrowing against? And it wouldn't even have to be a credit line. It could even be a flash loan for the bill you have to pay in that moment, right? Because you have all of that collateral sitting in your account, and the only hesitation is going to be how long does it take the cash to actually get credited to me? And so I do think that these will become services. I think that if we get the Clarity Act or if we get some more market structure enacted and more global regulations, I know they're very actively working right now in the UK and they have the MiCA rules that are coming in. I think this will become easier, and these are going to be new services that get offered regularly, right? And I think this is where there is such an interesting, super interesting convergence of agentive AI and blockchain coming together. Because really what I need is I need a logic layer that sits over my smart contracts that can actually start to algorithmically assess, right? Assess all the assets I have in my wallet, figure out my optimal form of payment or figure out my optimal collateral and automatically make a determination and create the contract to move that. And I think that's what will enable, Guy, that vision that you laid out there, which is, every asset should be almost instantly transferable into either collateral or cash. And then if that's the case, I need smart algorithms that are going to work at that speed that are really optimizing my options on how am I going to actually manage my overall pool of wealth. And this is why I think, to go back to what we were talking about earlier, this idea that I have different pools or different lanes that I manage my financial life in become untenable, right? Everything has to be together so that I am constantly optimizing all of my decision-making and all of my options to make sure that I'm earning the most potential I can with every asset that I have in my portfolio. And I really, really believe that that is the way that the future financial ecosystem is going to operate.
Yeah, like the vision is achievable if everything's inside of a wallet. If everything's on chain and inside of a wallet, we just need to kind of get there. And there's a lot of systems and sunk cost and legacy providers where most of the capital is that are not there yet. But I like this idea, Kai, that when you mentioned earlier that Luca at Cross River was able to do the stablecoin integration directly to their core, but they self-built their core and it's a 24/7 core. They're not reliant on that batch processing in order to catch up. So I think it's kind of fascinating that, Lloyds Bank here is doing something meaningful, that they're doing something useful that clients could get some value from. But it is one transaction. I'll be interested to see if this becomes many more transactions thereafter. And, would this buffer at scale, if there is then that giant gap between sort of what the on-chain record says and what the system of record inside the bank says. And I would love it, Sandy, if this became the thing that forced everybody to upgrade those internal systems over time, because that probably would unlock a massive amount of GDP. People don't realize how much working capital is tied up in dealing with just the delays in the banking system. Like, what a gift to the world unlocking working capital would be. How many jobs would we create? How much human flourishing would come off the back of that? But I want to draw your attention, Kai, briefly to the Canton piece. As well, because there's been a lot of discourse on X and elsewhere from some of the more crypto natives and true believers that, you know, Canton's not a real blockchain. It's not really decentralized. You know, most of what they're doing is with Broadridge on the RWA side, and I get the sense that there's a bit of a misunderstanding of how Canton's supposed to work, in that it's like the Swiss cantons. Like, yes, there are almost like the Avalanche model of, like, there's the core L1 and then there's these sub L1s that you can build on the subchains that they have, and so you could have something really, really big, but those are designed to kind of talk to each other. Your thoughts on the Canton portion of this?
Yeah, so first, like, shout out to Yuval and Eric, and, you know, these guys have been building for a decade. Like, so it's not like this is like an overnight thing that, you know, they launched something and, like, now you see all these announcements. It's like they've had a long-term vision that they've been building towards, you know, with, you know, a different approach than most of the industry has taken. And I think that they're now, you know, starting to get, you know, more and more traction and momentum. I think arguably Canton was one of the biggest stories over the past month, in terms of, like, where is there real activity and interest in, you know, more announcements, more partnerships, and integrations coming. You know, Canton Coin, I think, is up like 80%, you know, in the past month. It was one of the best performing crypto assets in the past month, which, you know, people wouldn't normally expect. And I think that's part of, like, what causes people to say, like, wait a minute, like, what's going on here? It's now like a $5 or $6 billion valuation, and so I don't understand all of the details, you know, enough around the, like, architecture and the mechanics of the network. I will say that it is pretty different than existing blockchains, and, like, by design. I think they've taken an approach that privacy is just a critical default feature that has to exist. And I think that was a good bet. And it seems today that, you know, institutions are validating that, you know, they're able to credibly go and say, we are a network that is operating on-chain, you know, use cases in a fully private way that's, like, live at scale. And, like, I don't know that many other networks that can say that. And so, you know, I'm excited to see kind of how Tempo privacy solution plays out. I'm excited to see what Arc does. You know, I'm excited to see what Solana does. So everyone else is, like, waking up to privacy is important and we have to build it, but nobody else is really able to say we have a live product and network that has privacy preserving capabilities that you can use today. And so I think that that's a pretty valuable thing for them to be able to go to market with. And my understanding of the way that it works is it is kind of this subnet type of structure where you have individual applications that an institution can build that has, you know, full privacy. And so it's kind of their own, like, you know, internal ledger. They can do any transactions that they want there that are, like, on us, you know, intra-bank, you know, transactions. But then there's this concept of the global synchronizer where you could have interoperability between these different apps. Now, what's not clear to me is how much of that interoperability exists at scale right now. It seems like most of the early use cases are individual apps. I think the Broadridge one, I could be wrong, but, like, I think that's like an individual app. But there is a growing ecosystem of some really, you know, impressive infrastructure providers that are enabling, you know, some of the nodes and capabilities for it. And there's just a growing list of institutions that are finding interesting use cases that they want to build on. So I think it has a lot of momentum right now and is pretty differentiated in the overall, you know, blockchain market for many capital market use cases. But Sandy, what do you think? Like, you've been following chains for a while. What's your, you know, Canton take?
Yeah, it's super interesting. I mean, we have deployed the infrastructure that we've built across 10 different public blockchains, and Canton is the only private blockchain that we have also deployed across. So we do run on the Canton network. We do run on the main Canton network, but we have done it for exactly the reason that you called out, Kai, which is we have clients who, because of their trading strategies, they want to be able to have privacy. They don't even want a wallet address available so that people can see kind of what's moving in and out of the wallet. They want that complete privacy because they feel like not having that, even if it's only pseudo-anonymous, really erodes their trading edge. And so I do think there's going to be very specific use cases that are going to always require privacy. And I think you're going to need to be able to offer a range of solutions. I mean, one of the reasons we've chosen to operate across so many different blockchains is we do find that there are a lot of different use cases, right? That we have a pretty complex set of order algorithms that really determine which blockchain we use for what types of orders, because we find that the economics of each chain are different, the characteristics of each chain are different. And so, people who always go back and say, oh, well, we're going to be in a one-chain world or we're going to be in a one-chain compatible world. I do think you're going to have to be able to interoperate across chains, but I still think that those chains serve unique functions in many cases. And I think Canton is interesting, and it is getting traction with a lot of traditional players who want that privacy, but who still want a chain that is actually up and operating and it's not being kind of spun up. To go back to what we were saying earlier about this whole idea of, I don't want it in the innovation lab. I want to be able to run a business on it. And so, yeah, we are deployed on Canton, and that is one of the networks that we're doing node operations on, and that is one of the networks that we operate across regularly.
Right. It's fascinating seeing how much sort of the reality of the world you live in with Canton and the client demand you have is something you have to respond to. And I think a lot of people that are coin holders on X, they can make a lot of noise sometimes, but don't understand some of the motivations and the drivers of some of these bigger institutions. And maybe that's not what they're trying to build, and all power to them if they're trying to build something else. There is one last story I just wanted to get a quick take on, Sandy, before we close out today, which is, I don't know if you saw that Morgan Stanley filed for an Ether trust after sort of a Bitcoin and Solana ETF push. They're also going to plan to launch their own digital wallet in 2026, which probably speaks a little bit to your everything will be a wallet thesis. But your thoughts on some of the financial institutions moving in this direction?
Yeah, I think that this move, and we're seeing it not just from Morgan Stanley, but I would say all of these major wealth networks, they have realized that clients have moved money away from their wealth management products to places where clients may not want to be operating long term, right? Like a lot of people have money that are holding on Coinbase right now that, given their option, they would prefer to move it back into Morgan Stanley and have it aggregated with all of the other assets that Morgan Stanley manages for them so that they can see their entire pool of assets. And in order to be able to bring those assets back onto their platform, Morgan Stanley has to provide both the infrastructure to hold the assets, which is the wallets, and then they need to allow these clients to determine if they want to redeploy that money out of a wallet and out of a crypto-based holding into an ETF. And so they're going to have some clients that want to go the traditional client account route, and they're going to have some clients that may prefer to start moving more of their other investments into the wallet. And I think that this is them putting into place the first stages of an infrastructure that's going to enable that two-way. And that is really how we think of our whole business, that, we're going to have to offer exposure to all of the crypto and the crypto ecosystem and the great development and growth going on there. And we're going to have to offer that in traditional wrappers that work in account-based systems and batch processed systems. And we're going to have to offer our traditional products that people are looking for diversification and for additional yield. And we're going to have to offer those in a wallet in a tokenized structure. So I think every financial firm is going to have to be able to interoperate across those two extremes for the next decade at least.
Wow. It's going to be an interesting challenge. A lot of work to do. The revolution will be tokenized, one financial institution at a time. Look, that's all we had time for this week. I want to thank our viewers for watching, listeners for listening as well. Sandy, if people want to learn more about what you're doing at Franklin Templeton, where do they go to do that?
Yeah, you can go to, I have my LinkedIn page under Sandy Kaul, and we also have Franklin Templeton Digital Assets. You can look that up, and all of our research is public. And we also have a great site called futureportfolios.com. And I encourage you all to check it out because it really explains this trajectory that we've seen of how we've gone from the 60-40 portfolio to where we think we're heading with wallets. So all those spaces, and we're happy to share more information.
I'm typing it in now. Kai, how about you?
On X at Kai Sheffield and visa.com/crypto.
You'll find me at SY Taylor wherever you do your socials, and you'll find me at tempo.xyz or screaming into the void over at fintechbrainfood.com. Thank you very much. I'm now going to do the thing where I ask you to like and subscribe and spam all of your friends to check out the show too, because that's how the show spreads. And if you like something that Sandy or any of us had to say, then this is the thing you send them. And we'll catch you next time. Bye for now.